Welcome back. You're with us in Trading Hour, still managing some green on the screen, just about 0.5% up on the benchmark indices. Let's take the market conversation forward. Abhisar Jain, head and fund manager of Monarch, is with us now to talk about the way forward. Abhisar, good to have you on the show. Thanks for joining in. So I'm just going to go back to all the data points that we were just discussing and this underperformance of India in 2023. Do you expect it to continue because we've had a great run last year, or do you think it's time for a pre-budget rally?
Yeah, so thanks a lot for having me on the show. I think we are quite constructive on the Indian market, mainly because of two key reasons. One is that going into this cycle, as my peers have also been saying, the balance sheets are in the the best shape possible for both the corporate India as well as for the banking sector, and that would help us going ahead as we move into the new credit cycle, as we move into the investment phase with all the PLI and the focus of the government on increasing the manufacturing. Second thing is that the market have spent quite a bit of time in this range. So if you were to see in 15 months back, we were at this range, what we are today. And we have spent this time, we have had an odd big dip in between, and we are still here. So that has made the valuation a little bit more reasonable. The premium is still there for the market versus its 10-15-year average, but it is much more reasonable. So we are constructive. And for this year, hopefully it should be an okay market which tracks its earnings.
Abhisar, morning. Rima here. I want to talk about that bold call that you made on super quality growth stocks in January of last year, where you believe that 54 growth stocks, which are high quality, but they are trading at astronomical valuations. Well, since then, in the last 12 months, we've seen the derating in many of these stocks. What is the call now? Which of these 54 stocks that you've identified, and where can we still expect to see some derating, and which ones have hit trough valuations or normalized valuations according to you?
Yeah, sure. So Rima, see, as portfolio managers, what we were kind of witnessing going into towards the end of 2021 was that for years no end, almost like 5-6 years, there was this lot of set of high quality stocks which were going up in share price more than what their earnings were doing. And this was consistently pushing the valuations for these stocks higher and higher. And that's when at the end of 2021, we decided to call it out. We kind of put a name to our note as the scary side of super quality stocks hiding in plain sight. Because believe it or not, this 55 stocks as a basket were trading at a PE of 85 times and the EV EBITDA or EV cash flow of more like 50 times. So notwithstanding the underperformance of 16% that these kind of stocks have had in 2022, still the absolute valuations are very, very high. And the earnings growth, more importantly, is the same as they have delivered in last 5 years, 10 years. Okay. Also, astonishingly, Rima, the premium for these own stocks with their own average of FY12 to 17 is still more than 100%. And the premium is still more like 40-50% to their 10-year average. So these include all the quality names, all the quality names from all sectors, consumer, industrial, IT, and these stocks we believe that will have some more valuation adjustment to go. Of course, some of them who surprise on the earnings positively can still do well, but we believe that the valuation adjustment has legs to go.
Please, could you name some of these stocks where valuation derating may continue to take place?
So Rima, we have mentioned that in our note in the annexure, this is a big list. As I said, the list has some of the loved large caps. At some point of time, these were considered at buy at any price stocks. So the largest paint companies features there, the largest consumer FMCG stock features there, some of the large IT companies features there, some of the industrial stock features there. And it's not about one stock as such, it is about a basket as a whole. And just to repeat myself that, there will be some companies which will deliver that very solid earnings growth and can still do okay. But a majority of them are not in sync with their earnings, and their quality was always there. It was always a well-established quality, but it's just that in the last 4 to 5 years, the multiples kept on increasing, and now adjustment might be happening towards the other side.
We try and push our luck. We don't have that annexure with us right now in the studio. Would you mind telling us maybe just 1 or 2 names where you really think that this whole derating has, more time ahead?
Yeah, so Surbhi, see, from the peak, this whole basket has fallen 30%, maybe Nifty has fallen only 5%. So the stocks that you were just showing on your screen, the HUS, the Asian Paints, the the other consumer names, the lot of IT names. IT names have of course seen a much more massive fall, and hence with kind of earnings which have been quite good, they may find finally a base. But there are a lot of others, in that list, which in our view will still underperform. So our call is on the basket. It's not on one individual name. And what we are saying is that the valuation adjustment, which has just started in 2022, may continue into the following years.
So how much of a further underperformance are you expecting in, say, in 2023 for the overall basket? I'm not going to ask you about individual names, but yeah, if you could tell us about the the full basket.
Yeah, sure. So see, Pavitra, the basket has underperformed in 2022 by around 16 odd %. Okay. So now I don't know what exactly will underperform in this year, but of course, I do believe that the absolute valuation for the basket, which is still a 55 to 60 on PE, which is still a 35 to 40 on EV/EBITDA, and which is more than 50 times on cash flow, leaves a lot of room to underperform, because as I said, this whole basket on its own valuation in FY12 to 17 period, when also they were quality, when also they were having these kind of earnings growth, is still at a more than 100% premium. So I'll not be surprised if the underperformance is to the same magnitude, some double-digit magnitude, maybe 15%, maybe a little bit more. But it should be in this calendar year also something around that, because we know that the liquidity is tight, the interest rates have gone up, and that also has it works against the valuation multiples, right?
Abhisar, out of time. Thank you very much for joining in. And those stocks that he was referring to include HUL, Asian Paints, Avenue Supermarts, Pidilite Industries, Divi's Laboratory, Godrej Consumer Products, Britannia, Havells, LTI Mindtree, Berger, Eicher Motors. The list is very long.
We should actually have him back once perhaps the earnings season is over, because that could be an immediate trigger as well, right?
Absolutely.
I also wanted to ask him what his take is on the hallowed consumer technology stocks, but that's a conversation for another time.
All right, for now, it's out of time on Trading Up. Thank you very much for watching. Halftime Report is up next.